Welcome to Smart Dollar Mindset, the channel dedicated to helping you achieve financial freedom with smart money habits and investing. Today's video is a deep dive into one of the most important topics for anyone serious about building long-term wealth, the investing mistakes you absolutely must avoid in 2025. Now here's the truth. Investing is one of the most powerful wealth-building tools on the planet. But the same tool that can make you financially independent can also destroy your financial future if you misuse it. One bad decision repeated over time can wipe out years of progress, and most people don't even realize they're making these mistakes until it's too late. In this video, we're going to walk step by step through 8 critical investing mistakes that you must avoid this year and beyond. We'll unpack why they're so dangerous, share real-life examples of people who fell into these traps, and most importantly, give you practical strategies to make sure you stay on track toward your financial goals. So grab a notebook, settle in, and stick around until the very end, because the final thoughts will not only tie everything together but also give you the mindset shift you need to invest with confidence in 2025. Mistake number 1, chasing hot trends and hype. Every year brings new investing trends, cryptocurrencies, meme stocks, artificial intelligence startups, or whatever else dominates headlines. In 2021, it was GameStop and AMC. In 2023, it was speculative AI companies. In 2024, it was the rush into green energy IPOs. And in 2025, you can bet there will be a new wave of so-called can't-miss opportunities. The danger here is obvious. When you chase hype, you're not investing, you're gambling. You're buying into a story, not a solid business or a proven strategy. And most of the time, the people making money in these hype-driven markets aren't retail investors, they're early insiders who sell when the buzz peaks. Take the story of Mark, a retail investor who put $30,000 into meme stocks at the height of their frenzy. For a few weeks, his portfolio doubled, and he felt like a genius. But because he was chasing hype, not fundamentals, he held too long. Within months, his $30,000 had dwindled to under $5,000. That loss set him back years on his investing journey. The lesson? Avoid the temptation of get-rich-quick trends. Stick to businesses, funds, and assets with strong fundamentals and proven long-term potential. Investing should feel boring, steady, and strategic, not like riding a roller coaster of excitement and fear. Mistake number 2, timing the market instead of time in the market. Another mistake that keeps investors broke is trying to time the market. This is the belief that you can buy at the very bottom, sell at the very top, and repeat the process for maximum gains. It sounds good in theory, but in practice, almost no one gets it right consistently. Studies from financial institutions have shown that missing just the 10 best days in the market over a 20-year period can cut your returns in half. Think about that, just 10 days. The problem is, the best days often come right after the worst days, which means if you panic and pull your money out during a downturn, you almost always miss the rebound. Consider the example of 2 friends, Anna and David. Anna invested $1,000 every month from 2000 to 2020, no matter what was happening in the market. David, on the other hand, tried to time his entries and exits. Over the 20 years, Anna ended up with nearly twice the wealth that David had, simply because she stayed invested while he tried to outsmart the market. The lesson here is clear: it's not about timing the market, it's about time in the market. The longer you're invested, the more compounding works in your favor. Mistake number 3, ignoring diversification. In 2025, one of the riskiest mistakes you can make is putting all your eggs in one basket. Diversification is the foundation of a strong portfolio, yet too many investors either concentrate all their money into one company, one sector, or even one type of asset. Take the 2008 financial crisis as an example. Investors who put all their money into real estate or financial stocks were devastated, while those who diversified across multiple sectors and asset classes were able to weather the storm. Or think about the collapse of individual companies, Enron, Lehman Brothers, or more recently, smaller startups that were once hailed as the next big thing. Employees who had their retirement accounts tied up exclusively in company stock often lost everything. Diversification doesn't mean spreading your money across hundreds of investments randomly. It means strategically balancing your portfolio across different sectors, asset classes, and even geographies so that no single event can wipe you out. It's not exciting, but it's what protects you from the unexpected. Mistake number 4, overlooking fees and costs. This is one of the most invisible mistakes, yet it can cost you hundreds of thousands of dollars over a lifetime. High management fees, trading costs, or expense ratios may seem small on the surface, but they compound against you just as powerfully as returns compound in your favor. Imagine you invest $100,000 for 30 years at an average 7% annual return. With a 1% fee, you'll lose nearly $600,000 in potential growth compared to an investment with low fees. That's not pocket change, that's the difference between financial independence and working extra years you didn't want to. In 2025, with so many low-cost index funds and ETFs available, there's no reason to be paying sky-high fees. Yet millions of investors still do, often because they never look closely at their account statements. Don't let this be you. Mistake number 5, following emotions instead of strategy. Investing is as much psychological as it is financial. Fear and greed are the two emotions that derail more investors than anything else. Fear makes you sell when the market crashes. Greed makes you buy when the market is soaring. Both actions lock in losses and reduce long-term returns. In 2020, when the pandemic triggered a sudden market crash, many investors panicked and pulled out their money. Within months, the market rebounded and reached new highs. Those who acted out of fear missed one of the greatest recoveries in history. The opposite happens during bubbles. In the late 1990s, during the dot-com boom, greed led people to pour money into tech companies with no earnings, just hype. When the bubble burst, trillions were lost. The antidote to emotional investing is having a clear, written investment strategy. When you know your goals, your time horizon, and your asset allocation, you're far less likely to panic or get swept up in euphoria. Mistake number 6, neglecting retirement accounts. In 2025, with inflation still affecting long-term planning and tax laws shifting, neglecting retirement accounts like 401ks, IRAs, or Roth accounts is a costly mistake. These accounts aren't just savings vehicles, they're powerful tools that offer tax advantages to supercharge your investing. Too many people treat retirement accounts as optional or delay contributing until later. But later often becomes never, and the compounding advantage of early contributions is lost forever. For example, contributing just $500 a month to a Roth IRA starting at age 25 can result in over $1 million by retirement age, assuming modest returns. Waiting until age 35 to start cuts that amount nearly in half. If your employer offers a 401k match, not taking it is literally leaving free money on the table. Yet millions of workers still fail to contribute enough to get the full match. Mistake number 7, not having an emergency fund. What does an emergency fund have to do with investing? Everything. Without an emergency fund, you're forced to liquidate your investments whenever life throws you a curveball, medical bills, car repairs, or job loss. And often, those emergencies happen during market downturns, which means you're selling at the worst possible time. A properly built emergency fund of 3 to 6 months of expenses creates a financial buffer that allows your investments to stay invested. It keeps you from raiding your future to cover today's problems. Real-life example, during the 2008 crisis, many people lost jobs and were forced to cash out retirement accounts just to survive. Those withdrawals locked in massive losses. Meanwhile, those with emergency funds intact were able to leave their investments alone and came out far ahead in the recovery. Mistake number 8, failing to continuously learn and adapt. The final mistake is failing to keep learning. The financial world changes constantly, new asset classes, new tax rules, new technologies. What worked 20 years ago may not be the best strategy today. For instance, decades ago, pensions were common, and retirement planning was simpler. Today, individuals must take far more responsibility for their own retirement through self-directed accounts. Similarly, the rise of digital assets, fractional shares, and robo-advisors has changed the investing landscape. Investors who fail to keep learning and adapting often fall behind. The most successful investors don't chase every new trend, but they do stay informed enough to make educated decisions. Continuous learning keeps you flexible, confident, and prepared for whatever comes next. Final thoughts. So, those are the 8 investing mistakes you must avoid in 2025. Chasing hype, timing the market, ignoring diversification, overlooking fees, following emotions, neglecting retirement accounts, skipping an emergency fund, and failing to keep learning. But here's the bigger picture, all of these mistakes come down to mindset. Wealth isn't built by luck or quick wins, it's built by consistent, intentional decisions made over years and decades. Every dollar you save and invest is a worker you send out to build your financial future. But if you let hype, fear, or laziness take control, those workers get wasted. The key is to shift from a short-term mindset to a long-term wealth-building mindset. Instead of chasing trends, focus on fundamentals. Instead of trying to time the market, stay invested and trust compounding. Instead of panicking or getting greedy, stick to your plan. Instead of ignoring opportunities, educate yourself and take advantage of tax-advantaged accounts. And instead of being forced to raid your investments, build a strong emergency fund that protects your future. Remember, financial freedom isn't about being perfect, it's about avoiding the big mistakes and letting time and consistency work in your favor. Every choice you make either moves you closer to independence or further into financial stress. The great news is that you have the power to choose wisely starting today. If you take these lessons to heart and avoid these 8 mistakes, your 2025 investing journey will be one of growth, confidence, and long-term wealth building. Thank you for watching Smart Dollar Mindset. If you found this video helpful, please like, subscribe, and share it with someone who's ready to take their investing to the next level. This channel is all about helping you achieve financial freedom through smart money habits and investing, and together, we're building a community of people who refuse to stay stuck in financial stress. Stay disciplined, stay consistent, and remember, the best investment you can make is in your own financial education.